Hi friends, welcome to Crack Grade B. We are back with yet another very important lecture from your ESI syllabus for the upcoming examination, that is NABARD GRADE A. Like you have seen in our YouTube channel that the notification is expected very soon, and it is also expected that the NABARD GRADE A could be can come with a different pattern of examination, right? But that's all expected. Whatever it comes, we will have to follow. So let's continue in the direction of learning. That should not stop when it comes to preparation, right? So this is one of the topic where most of the people who starts preparation with this topic, because this is first in your syllabus, measurement of growth. And yes, this is one of the important topic, because if you do not know measurement of growth, you cannot connect the next few topics, right? So in this particular lecture, we are going to understand some of the basics of it. Then we are going to look some questions, right? So this lecture will be more focused on objective centric lecture, right? So yes, I would tell you what's the basic of it, but we will not go in depth of the basic. We will only look at the objective perspective of this particular topic, right? So let's begin. Let's begin with growth and versus development. So what is growth and what is development? Are they synonymous to each other? Absolutely, they are not synonymous, right? They are synchronized. How they are synchronized? Development cannot be possible without growth. Now, and growth without development is useless, right? So these are inclusive terms. This complements each other, right? Now let us understand what is growth. See, growth is about numbers. This growth is about numbers. Right? Growth is about numbers. Today the economy can produce an amount of 100 rupees. Tomorrow it should be able to produce an amount of 110 rupees. Day after tomorrow it should be able to produce 120 rupees, and so on. This is known as growth in terms of number. But this in no way guarantees that the people in the economy lives a prosperous life, right? So growth do not guarantee that the people have prosperity. What is prosperity? Prosperity is where they have access to good healthcare, they have access to good schools, their social indicators are good, they have access to proper sanitation facilities, they have proper access to infrastructure in terms of road, connectivity, telecommunications and everything, right? So growth in no way guarantees development. And development without growth is, in the first hand, it's not possible. Just think, how will a government build road when the economy is not growing? The government will only have revenue in its bucket when the economy is growing, right? Only then it can spend that amount and develop a particular region, right? This is the first perspective of it. And what is the second perspective? The second perspective is that the development without growth is useless, right? If my country is not growing and I am growing, what is the use? I will not have access to proper infrastructure, right? To even grow myself. So that's completely useless and baseless to think. So there are two perspectives. Number one, growth without development is not possible and it's not viable, right? And then development, so that was that was development without growth. Now growth without development is useless, right? Because the country may go up in numbers, but the people living in the country will not go up. The social indicators for the people will not improve. What is the use? For whom does this economy is growing, right? It should grow for the people of that particular country. Like for India, it's us, for you, me, everyone out there, the 1.3 billion people. So the growth should be to complement the prosperity of this 1.3 billion people, right? So that is the difference between the growth and development. So here, let us split the syllabus into two parts. The first part is about growth. We'll talk about number, we'll talk about the data that CSO has to keep, we'll talk about the data that RBI has to keep, we will talk about the data the Commerce Ministry has to give, right? Now, and obviously the Office of the Economic Advisor, the economic survey comes out from there, right? So we'll talk about numbers when we look at in terms of growth. But when we look at the syllabus in terms of development, there is health, there is poverty, there is unemployment, there is urbanization, right? And all the social topics that comes under development. So I hope I could able to split the syllabus between this growth and development. So this topic becomes much more important than any other topic, right? Obviously all the topics are important in the syllabus, but this becomes this holds more important, because if you have understanding of this growth and development, the rest it becomes easy. Let's move forward in the lecture. Let's see. Yeah. So what is GDP? When we talk about growth, we talk about GDP, right? What is GDP? GDP is the market value of final goods and service produced within a domestic territory of a country measured in a year. So domestic territory, that's the keyword, right? Domestic territory. So whatever is produced in this domestic territory of India will be, and the Andaman and Nicobar Island will be the GDP of the country, right? Whatever is produced within this, whatever the service produces and the goods produced in this geographical boundary, it will be counted in terms of, it will be counted in GDP. We will have to note here is no intermediate goods is counted here. Why? Because if there is an intermediate good, one or the other day it will be produced into the final goods, right? So that is why we do not count the intermediate good. So what is intermediate good at the first place? Intermediate good is a good that is used to produce a final good. Let's say the screen on your laptop, right? Or the, see, what is the use of the mobile cover that you have? So until and unless you have a mobile, the cover has no utility to it, right? So that is how the intermediate goods works. So the engine would be the intermediate good for a car, tire would be the intermediate good for a car. So car is the final product, the tire are the intermediate goods, right? So the bread that we eat, so bread is the final product, the flour that is used to make that bread is the intermediate good. We are going to understand in the later part of the lecture, right? So I hope GDP is understood. GDP is the market value. Note, GDP is the market value, means if you are buying a Parle-G that cost you 5 rupees, that 5 rupees will be counted. So that 5 rupees is counted, not the producer's side. So maybe the producer had produced it at rupees 4, because they are here to earn, right? So they will earn 1 rupees. So it is not from their side. So when we calculate GDP, we do it in from, I mean, the definition is from the market side. The market value of each and every goods or the service produced within the geographical boundary of the nation is known as gross domestic product. I hope this is clear. Let's move forward and let's see how GDP is measured, right? Number one, so these are they have 3 methods. one is expenditure method, the second one is the product or value added method, third one is income method, right? The third one is income method. So let us understand each one of them one by one. The first one is expenditure method. So when it's come to expenditure method, by the name itself it is clear that expense जो हम खर्चा करते हैं वो, ठीक है, expenditure method. So expenditure method is calculated using this formula C plus I plus G plus X minus M, right? So what are this? We are going to look at it, right? Let us understand in the next slide. So what is C? C is private final consumption expenditure. I is investment. G is government expense. X export. M means import. Now let us understand each one of them, right? So you will have to listen to me carefully because it's not written. Private final consumption. So what do we mean by private final consumption? See, who are the private people? You, me, right? So this all the 1.3 billion people who are spending to live their day-to-day life comes under private final consumption. Okay, let's say we buy our groceries. Will that be counted? Yes. Grocery. Yes. We live in a home. So either we live in a rented home or we live in our own home. Means we have purchased it, a flat, or we have built it, whatever. It will also count it in private final consumption, because even if you live in your home, it is seen as you are giving rent to yourself, right? You are giving rent to yourself. So own house. So if you are giving rent, obviously that is under the private final consumption. Why? Let's say I live in a rented home and I give rent to you. Okay. So the moment I give rent to you, what will you do with that money? You will use it in the economy. So the moment you use it in the economy, either it is going to be private final consumption or it is going to be the investment, right? So let's say 5,000 rupees and you use that 5,000 rupees to save, to buy some shares, bonds, etc., gold. So that comes under I, investment, right? So understand the logic behind it. So own house. Yes, own house, you count it, right? So that means private final consumption expenditure, right? Now what is investment? Investment is investing the money in gold, bond, debentures, shares, buying a new property. Yes, buying a new property. See, when you have bought the new property or the new house, it will not be counted in C part. You, me, everyone. What I told in the beginning, private final consumption means when we invest something, I mean when we spend something to live our day-to-day life, that will be counted in private final consumption. But understand one thing, that house is something that we do not invest daily, maybe once or twice in the lifetime, right? So, and house or a plot or a flat is basically looked upon as an investment. So whatever we invest on that regard, it will be counted in the I part, not in the C part of it, right? So understand the difference between the investment and the final private final consumption expenditure. Then let's move to government expenses. So where does government spend money in, right? Most of the government, how does government spend money in? Number one, salary to its employee. Number two, pension. Okay, let me write pension here. Pension. Number three, subsidy, right? Then procurement or investment. procurement or investment? Now, salary and pension. Will this be counted in government expenses? Yes. Then, subsidy, will this be counted? No. Why? Because when you are getting subsidy, you are spending it. So, it will be counted in private final consumption, not in the government expenses. Procurement, yes. Procurement, yes. So, that is how the government expenses is counted, right? Then, export minus import. So, you know it. Export means amount of goods sold from amounts of goods and service sold or sent from the geographical boundary of India to the foreign country. And import is the opposite, amount of goods and service received from the foreign country to the geographical boundary of India for consumption. I hope this is clear. Let's move ahead in the lecture and understand the next one. So, what was the next one? The next one was the product or value addition method, right? So, to understand that, we need to know few things. Factors of production, right? So, what are factors of production? Number one is labor. Labor. Number two, land. Number three is capital. Number four, entrepreneur, right? So, why these four are factors of production? Let's say I want to start business, right? So, what I need at the first place? Money, the capital, Now, I have capital, right? What I need next? I need a place from where I can start my business. Absolutely, without place the business, maybe I can, so if it is a service, so maybe you have heard that Microsoft, Facebook have been started in a garage. Yes, that garage is a land. So, that garage is a land. So, factors of production doesn't say that you need to have a very big place. So, a company like Microsoft and Facebook have been started in a garage, and that's the second factors of production, that is land. Then, now I have capital and now I have land. Now, what I need next is the labor. Who is going to work? Skilled, unskilled, that is altogether a different thing. But there has to be someone who works in the process of manufacturing or in the process of delivery of service, right? So, that's labor. Now, I have land, labor and capital. But who I am? Who is planning to do the business? Who is planning to do this economic activity? I am an entrepreneur, right? I am an entrepreneur. So, these four things are known as factors of production. To make anything, we need to have this four thing as the minimum requirement, only then we can proceed, right? So, these are the factors of production. Now, let's move ahead and the product or gross value added method, let us understand this one, right? Let's suppose you want to make this car. So, what are the things that is required to make this car? Let's say we'll need steel to make the body, we'll need rubber to make the tires, we need glass to make the window area and the windshield area, and finally we can make the car, right? That's XUV 500 that we can make. Now, how we are going to make it? Let's understand. So, in each step, in the first step, factors of production employed, right? So, the value at this point is 0, and then let's say using this we have manufactured what? Steel. Using this factor of production, we have manufactured steel. Let's say value is 1 lakh. Value is 1 lakh. And using again the factor of production, we have now manufactured the engine and body. And now the value is 5 lakh. So value addition at each step. So first step from 0 to 1 lakh, then it's 5 lakh, right? Then in next step, let's say we have made the tire, means we have added the tire and the value becomes 8 lakh. Then finally we have added the glass area and now the value becomes 15 lakh, right? So what is the amount that we have added in each stage? So from this to this we have added 1 lakh, from this to this we have added 4 lakh, that's 5 lakh minus 1 lakh, that's 4 lakh. From this to this we have added 3 lakh, and from this to this we have added 7 lakh. So what would be the GDP at the product or gross value added? So it would be summation of this: 7 plus 3 10, 10 plus 4 14, 14 plus 1 15. So 15 lakh, right? That's 15 lakh. So in every stage we are calculating the value addition. So at the stage 1 the value was 0, we employed everything and we made steel and the value became 1 lakh. Then we employed the steel and again the factors of production, we made engine and body and the value became 5 lakh. So we have added 4 lakh gross value addition. So what is the gross value that we have added, right? We have added 4 lakh. Then from this stage to this stage we have added 3 lakh and so on, and finally when we calculate the amount at each stage we are going to get 15 lakh. Now I hope this is clear, but one thing you need to understand here, the number we have got, but what is this, right? So this is GVA, this is GVA at the rate, let us remove everything. So what we got, it's GVA at the rate basic price. So what we got was GVA, gross value added at the rate basic price. Now when we need to come from basic price to the market price, how we are going to get, or the current price, plus tax minus subsidy. So and this is known as, this both is known as net tax. This is known as net tax. So what we need to do, we need to add, so the amount what we got is 15 lakh. So in 15 lakh we need to add tax. So government taxes everything, right? Now it's GST, government taxes everything, we need to add tax. And also government gives subsidy in some of the product, like in electronic e-cars, government gives subsidy. So we need to remove the subsidy amount. Only then we can get GDP at the rate current price. CP is current price, right? So when we do that, what we will get? We will get GDP at the rate current price, right? Current price means the price that is prevailing in the market. But what if we need to come to the constant price? We will adjust with what? Base year. what is the base year? It's 2000. We'll adjust this price with the prices of 2011 using GDP deflator that we are going to see at last, and we will come at GDP at the rate market price, GDP at the rate constant price, GDP at the rate constant price. So that is how we compare, right? So to compare we need an old data and we need a current data, only then we can compare. And when we need to compare growth, we cannot compare it in today's price, right? So the number will come high because of inflation, right? So we need to adjust it to some older time, and the adjustment that we do is from 2011 price, and when we adjust it we get the comparison data, right? Now let's move forward in our lecture and let us understand what CSO does. So what you can see in your screen is the GDP calculation using the expenditure method by the CSO. So CSO does it differently. Whatever we have learned is from NCERT. CSO does it something different. So private final expenditure. The first one is private final expenditure. What we have seen? So this is C. This is okay. This is I. Gross capital formation plus change in stocks plus valuables. So this is I. This is G. Government final expenditure, final consumption expenditure, GFCE, and then you see X minus M, the 6th and 7th point, export minus import. But see, you can see a point number 8, that discrepancies, right? So what is this? So this is what the CSO does it differently. What CSO calls is this method, the limitation of this method. This method cannot be 100% foolproof. So that is the reason this amount comes from the income method. So it also calculates in the GDP in the income method, and the difference amount they add it in the discrepancies, and final they are taking the data from the expenditure method, right? Now let's move forward in the lecture and let's see income method. So what is income method? By the name itself it is clear, the income that we generate as an individual, as an organization, as a government, right, as an NGO or as anyone. Income method. So using the income method, let's calculate. So it's very simple. It's W plus I plus P plus R. What is wage? W, wage. What is I? I is interest. What is P? Profit. What is R? Rent. But we need to look at different way. How? So wage. Wage is income. Wage is income of the people. What is interest? Interest is, what is interest? Interest is capital. What is profit? Profit is entrepreneurship. What is rent? It's land. So can you see, it's land, labor, capital, entrepreneurship. So income method means factor income generated from the factors of production, right? So why I didn't tell you? Because I need to give you the connection. So it's W, I, P, R. The summation of W, I, P and R. What is W? W is wage, means income. What is I? I means interest. Interest means capital, right? P is profit. Profit means entrepreneurship. That is why you do a business, right? Profit means entrepreneurship. Then rent. Rent, where does the rent come from? Rent comes from the land. Land. Sorry for the handwriting. It comes from the land, right? So factor income, it's factor income generated using factors of production is called means the GDP that we get will get it from the income method, right? Hope I am clear with this. Now let us understand it in a detail using this circular flow of money. Now see how a money circulates. So let us start with the household first. So this is an household. So in every household, in my household, in your household, see, you are preparing for an exam. So you are a student, right? But what if you are earning? So there are many candidates who are earning. You are earning means you are running an household. You are buying your bread and butter, right? So you are spending, consumer expenditure. You are spending and you are giving money to whom? To firms. To firms. What kind of firms? The firms that is making your bread and butter, that is making that dal chawal, that is making the clothes that you are wearing, the firms that are into the service that you are taking up, right? Like maybe you have a mobile phone with Jio SIM card, Airtel SIM card or Vodafone SIM card. The service that they have to offer, you are paying a monthly fee towards it. You are using internet, you are paying a monthly fee towards it, right? So you are spending and giving money to whom? Firms, right? And then you are also receiving the this is at the first place, and what is at the second place? So some of you may be working in the manufacturing industry, means you are the factors of production for the firms. You are the factors of production for the firms. Many of you may be working in the telecom company, so that's service industry. Many of you may be working in the grocery sector, right? So that is how this household generates, this household contributes in the economy. So they spend to buy their daily needs and also the luxury goods, and they are also become a part of factors of production for the firms producing those, right? So maybe I work in a biscuit company. So I want to eat biscuit, I'll eat biscuit, right? So I need to buy that biscuit. So I am getting salary from that manufacturing unit, let's say Britannia, okay? And I am again going to market to buy that Mary biscuit of Britannia for my consumption. So what I am a factors of production for the Britannia at the first place. At the second place, I am receiving wage from the Britannia, and again on the consumption part, I am buying that particular good from the market, or maybe I buy it from my own factory and I pay to them, right? So this is how the money is being circulated, moves from one hand to other hand. So see, now these firms pay wages, rents and dividends to the households, right? So understand the circular flow of money. So the money flows from the one hand to the other hand, from the household to the firms, from the firms to the household, right? And through this, I hope the income method is clear, right? You are receiving wage, you are receiving rent, you are also a part of factors of production to the firms, and you are also spending the money that you are earning, right? You are also spending the money that you are earning for your daily needs. So that is how the circular flow of money works, and that is how the WIPR, W plus I plus PR, that is income method, calculates GDP from, right? Now let's move forward in the lecture with some macroeconomic identities. Okay, the one thing that is left is, let me go there. Okay, now we are done with expenditure method, product method and income method. So all three things are completed, right? Now let us see some macroeconomic identities. But before we see macroeconomic identities, let us understand what is real GDP and what is nominal GDP. Nominal GDP. So see, nominal GDP is GDP which we calculate on the current price, which we calculate in the current price, means the price that is prevailing in the market, right? So this is also known as market price. Okay, but what is real GDP? Real GDP is where we compare it with the previous year. I mean, compare it with the over a period of time, right? So this is adjusted for base year. This is also known as constant price. Constant price, this is current price. This is also known as market price, means the current price, and this is the constant price, means the price from 2011. This is adjusted for the base year. Okay, so this is the difference. Now we need to understand one thing, GDP deflator, right? So what is GDP deflator? So GDP deflator is nominal GDP upon real GDP. Nominal, so the amount that we get, the growth numbers that we get using the expenditure method, right, is being adjusted using GDP deflator, and this is the GDP deflator, the nominal GDP by real GDP. What is nominal GDP? Its current market price. What is real GDP? Adjusted for base year or at the constant price, right, at the constant price. So you will have to remember this formula and understand the difference. Again, I am repeating, nominal GDP is the amount that is prevailing in the current market price, right? Let's say I buy a Parle-G for ₹5. That means the calculation in the nominal GDP would be ₹5. But the calculation in real GDP for that Parle-G would be, what was the price of that Parle-G in 2011? Maybe it was ₹3, right? So it will be adjusted accordingly. Means we will calculate ₹3 and we will look the numbers, we will look at the numbers it has produced and then the comparison, right? So I hope I could make you clear between nominal GDP and real GDP. So this is a macroeconomic identity, GDP deflator. GDP deflator, right? Now let's move forward. So there are many things. Number one, there is gross domestic product, right? Number two, there is net domestic product. Number three, there is gross national product. Number four, there is net national product. What is the difference between all this, right? So what is GDP? GDP is the amount right? We have seen the definition. The amount of goods or service produced within the geographical boundary of India is known as GDP. Then what is NDP? Net domestic product. So what is NDP? NDP is GDP minus depreciation. It's GDP minus depreciation. What is NDP? It's GDP minus depreciation, right? Now, what is GNP, right? So GNP is, it's GDP minus net factors income from abroad. It's NFIA. Let us look into it in the next slide. So what is GNP? It's GDP minus net factor income from abroad. Now what is net factor income from abroad? Now see, what is GDP? जो हमारे देश के जियोग्राफिकल बाउंड्री में बनता है. सो whatever the goods and service produced within the geographical territory of India is known as GDP. But what is gross national product? Now see, so there are Indians who are working abroad, they are sending money, they are Indian, right? So even if they don't send money, they are Indian. So that is our national. Our people earning anywhere in the world would be our income. Means that would be all the foreigners, all the Indians working in the foreign country. We will add that amount and now add that amount to the GDP. But now understand one thing, the moment we add the amount of our people employed in the rest of the world, apart from India, right, in the rest of the world, we need to subtract the amount that are being earned by the people living in India. I mean, subtract the amount that are being earned by the foreigners in India, right? Fix it. Let me repeat. GDP. What is GDP? Goods and service produced within the territorial boundary of India. But India का सामान तो हमारे बाउंड्री से बाहर भी बनता है, right? बाहर भी बनता है. Like the Tata and Mahindra have their plant in America and Europe, right? They have it. तो उस कंडीशन पे हम क्या करेंगे? Whatever our earning are outside India, we will add those amount. But when we do that, we need to think that Samsung also have manufacturing plant in India, right, in Noida. We need to subtract that because that's a North Korean company. So adding all Indians employed in rest of the world, ROW, and subtracting foreigners employed in India. So the money that is being generated by the factor income from the ROW, rest of the world, will add that and will subtract the factors income that is being generated in India by the foreigners. This is known as NFIA, right? And when we subtract that from GDP, we get gross national product. Now, what is NNP then? NNP is nothing but GNP minus depreciation. It's GNP minus depreciation. So I hope this is clear. So now let's move forward and understand three important words. Number one, factor cost. What is factor cost? If I ask you what is GDP at factor cost, the answer would be understand factor cost. So you can keep it in your memory like factory cost. This means that where does a good or service produce? In a factory. See, what I am producing now is a service, right? So I am doing it from my home. I am doing it from my home. So the cost that is getting involved at this particular place is the factor cost. Let's say Parle-G. Okay, the cost of the Parle-G in the market is ₹5, right? But what was the cost of that Parle-G at the factory gate? At the factory gate. उसके बाद वो जब मार्केट में आया, what are the things that got added into it? The tax got added at the first place. The GST for the biscuits that is being added, and the profit that is known as the spread, the profit that the manufacturer has, the Parle company has added to it. Okay, so the cost that was involved to make that particular biscuit means जब वो factory पे था, at the factory gate, it was not out in the market. The moment it goes out in the market like this, what are the amount that is being added? Number one, the taxes. Number two, the profit, right? So the cost at the factory gate is known as factor cost. Cost at the factory gate is known as the factor cost. Then let us understand market What is market cost? What is market cost? अभी देखो factor cost तो हमने देख लिया. Now we know what is factor cost. What is market cost? So if we add tax here, factor cost plus tax minus if government is giving any subsidy, what will it become? It will become market cost. It will become market cost or market price. I hope you understand this, because this is very confusing. GDP at factor cost, GDP at market cost. So how will you come from, there can be objective like they will ask you how do we calculate GDP at the factor cost, and the option would be plus tax minus subsidy plus net tax. So this is also known as net tax. So if in objective you had a question like this, that how to arrive at GDP at the market cost if you have the data of GDP at factor cost. Okay, so this will not be the objective, but I am making you understand. So you need to add tax plus subsidy, or this is also known as net tax. Right, so even if the option says factor cost plus net tax, it's okay, and if it says tax minus subsidy, then also it's okay, right? So this is how you arrive. Now you know the difference between the real, so all the terms are clear. Real GDP is clear, nominal GDP is clear, current price is clear, constant price is clear, market cost is clear, factor cost is clear. So all the identities is clear, and in the previous slide all the four identities GDP, NDP, GNP and NNP is clear. And I am sure this when an objective is being framed from all these identities, it becomes confusing. Now let us move ahead and look at it. Look at some of the questions that were asked in the previous year paper of NABARD Grade A, right? How would a free market economy be described? Free market economy. How would an market economy be described? Right? Market economy. So the first option is an economy in which decisions are made by the government rather than by the interaction between the consumers or business, consumer and business. Is this a market economy? All the decision is made by the government? Absolutely not. Right. Then option B, the international exchange of goods and services. Yes, that's market economy because that is how you trade. But they are telling about free market economy where there is no restriction. An economy based on supply and demand with little or no government control. So that's the free market economy. So option C is the right answer. Right. So this is your answer. So this is how you need to solve an objective. You need to look at the term, the keyword. It's free market economy. So if it was only market economy, option B would have been also the right answer. But it says free market economy. So free market economy means where the government do not have or have very little control. Means the businesses are free to take their own decisions. Then let's move forward in the next one. GDP deflator is defined as. So what is GDP deflator? Right. So let me go back to that particular slide. So this nominal GDP upon real GDP. Right. GDP deflator is defined as real GDP upon nominal GDP upon real GDP. So option D is the right answer. Right. So now you see how this topic becomes important. Then economic growth can be measured as percentage rate increase in the dash. Economic growth can be measured as the percentage rate increase in what? Right? National nominal gross domestic product, real gross domestic product, national income, per capita income, or either A or B. What is the right answer? So the correct answer is this. Nominal gross domestic product as well and real gross domestic product as well, right? Because we can come from the nominal, we can come to real, and from the real we can go to nominal using GDP deflator, right? So we can calculate using both. Then let's move forward. So one of the term that I want to make you explain is the per capita income here. So what is per capita income? Means every people in the country and their income. It's not about their income, it's about the nation, right? So how it is calculated? It is calculated by the GDP upon population. That is the per capita income. So many a times you have heard that India is in terms of PPP, purchasing power parity, India is higher. But in terms of per capita income, India is lower than even Bangladesh. Why? Because the population is high here. So so our economy size is around 2.5 trillion. 2.5 trillion divided by 1.3 billion. That is how we come to per capita income. माने एक आदमी कितना कमाता है? That's an average. That's a simple formula that we use. Okay. Let us move forward. With reference to gross value added, which of the following statement is correct? GVA. Where did we read this GVA method? GVA at the basic price. Where did we learn this? In which method? We learned this in a gross value added method. Right? So how it is defined? It is defined as the value of output minus the value of intermediate consumption. Its estimate is released by NSO. From an economic perspective, it represents the supply side. In India, GVA is calculated at the basic price. Now, I have already written GVA is calculated at the basic price, so this option is correct. Again, the estimate is released by NSO, National Statistical Office. Right, then from an economic perspective, it's representing the supply side. Yes, because we are calculating thing inside the factory, means from the supply side. Yes, that's also hold true. Then it is defined as the value of output minus the value of intermediate consumption. Yes, this is also correct. So what we did, the output minus value of intermediate, we have reduced it. Let us go back and let us see so that things become clear. Okay, so that has been rubbed, so you cannot see it. Now let's move forward to the next question. A market failure can best be described as a situation where market fails to allocate resource efficiently, market encourages people to take risk, market enable buyers to gain utility, market fail to enable sellers to make profit, and none of the above. Now, what is the question talking about? A market failure can best be described as a situation. Market failure, right? Look, if the market encourages people to take risk, it's good. Market enables buyers to gain utility, obviously that's good. So whatever we buy in our life should have a utility to it, right? So it's a macroeconomic concept of marginal utility, right? So everything should come with an utility. Then market fails to enable sellers to make profit, wrong, right? Where the market and then none of the above. Now see, within this option number D and option number A, market, which is the bigger one, a market failure, right? So it is not about the sellers only. It is, the question is about the market, means everyone, the seller, the buyer, the consumer and the producer, everyone in the market. So this option D tells only about seller. So that's also not. So option A is the right answer, where market fails to allocate resource efficiently. So this is all about growth and development. What I told in the beginning, that growth, development without growth is of no use, right? So when the economy is growing, the resources that the economy is producing or generating should be efficiently distributed among the sections of the society, so that there is an inclusive development, right? So that there is an inclusive development. With this particular lecture has come to an end, and let me tell you that do visit the website to check out these different courses and have a look. This is the price of the NABARD Grade A and NABARD Grade B course. This is one of the most economical course that you can find in the country, for 2499 for NABARD Grade A and 3499 for NABARD Grade B, right? Then with this, the lecture has come to an end. Thank you and happy learning. Next, let's meet in the next lecture. Thank you so much.